Hi, welcome to PSI, Plan, Save and Invest. As we all noticed, Indian markets have been correcting over the past 6 months, from October last year to March this year. This is a significant fall of 15%, but it is considered good because the latest fall is due to sentimental factors, but not the fundamental ones. Sentimental factors like geopolitics, US tariffs, wars in Israel and India against terrorism. Also, FIS considered Indian markets are trading at higher valuation, so they started selling, starting of this year in the month of Jan, Feb, and March. Well, things have been settled down over the past 2 months, and markets have been bullish. But what factors can we use to say that the current Indian market's trend is bullish? To answer this question, we considered 3 factors. 1. Sentimental factor. 2. Technical indicators. 3. Fundamental factors. So let's examine the first one, sentimental factors. Wars have almost settled down. US tariffs are under negotiation and FIS have started investing in India. Sentimental factors, these are unpredictable. Global issues, everywhere in the world, some or other issue keep happenings, and nobody has actual control on sentimental factors. But currently the sentimental factors are settling down. That's what we can anticipate. And the second factor, golden crossovers on technical indicators. So what is golden crossover? So golden crossover is a concept in technical analysis. This indicates a long-term bull trend and a rare buy or bullish opportunity. This occurs when 50 exponential moving average crosses the 200 exponential moving average. Also, we observed this crossover first happened on Bank Nifty daily chart, followed by the Nifty daily chart. So we can say that banks and financial services are pushing up the Nifty. Also, we got a second confirmation supporting our golden crossover by super trend indicator indicating bullish on the weekly chart, both on Nifty as well as Bank Nifty. However, we should never forget that fundamental reason should support every technical fact. So without fundamental reason, you should not rely on technical indicators. So let's see what are the fundamental factors and whether they are supporting the current bull trend or not. As we all know, the key fundamental facts for Nifty or Bank Nifty, are like current economic phase of India, GDP growth rate of India, inflation rate, and interest rate. So these are the primary key fundamental factors. Using these data, we can anticipate or predict the future outcomes and performance of the Nifty. So let's see the fundamental factors. The first one is economic cycle or business cycle phases. This is a general educational graph used to represent a country's economical phases. We can identify a country's economic phase based on GDP growth rates and inflation rates. Below you can see here the scenarios explaining each phase of the economic cycle. Let us use these parameters to identify the economic phase that currently India is witnessing. So we take an Indian GDP annual growth rate from a reliable source, that is trading economics. You can see the GDP growth rate. India is consistently maintaining above 6%. GDP growth rate at above 6%, which is actually considered a very good growth rate globally. Also, there is an anticipation that Indian growth rate, GDP growth rate, could be 7% in the following years. So the next fundamental parameter is Indian inflation rate. If you see the graph here, you can observe that the inflation rate is easing and consistently falling, dropping below 5%, which is a good scenario As per reliable sources, and these are like, as per Indian Ministry of Affairs, as per reliable sources, Indian GDP growth rate is stable at 6%. The inflation rate is falling from a moderate rate of 5%. Looking at these numbers regarding the economic cycle, we can see that the Indian economy is still experiencing the expansion phase, that too early expansion phase. So you can see this business cycle graph here, which is stating that if the GDP growth rate is stable to modest growth, and inflation rate is moderate to falling, it is considered as an early expansion phase. So there are actually three phases in the economic cycle. One is expansion phase, another one is peak phase, another is contraction phase. So in the expansion phase, there are again two phases. One is early expansion phase, second is late expansion phase. As per our GDP growth rate numbers and inflation rate numbers, we can tell that currently India is experiencing early expansion phase. The economy is in the early expansion phase, which will be followed by late expansion phase, then peak, later contraction or recession depending on the time and the various factors at that time. So generally, as per economic theory, states that each economic phase lasts about 5 to 10 years or more. So we can expect early expansion phase of economy for a couple of years as well. So it's good, India fundamentally strong. Another critical factor is that Indian inflation rate has been constant at 6.5% for almost 2 years and has witnessed rate cuts by the RBI over the past few months. For last 2 years, 6.5%, India is maintaining the constant repo rate at 6.5%. But from the past few months, because the economy is recovering and things are at stable, RBI started cutting the rates. The current interest rate is at 6%. If Indian inflation remains under 5%, we can expect the repo rate to fall below 6%, which is a very good scenario, because the loan takers, loan borrowers, will wait for interest rates to drop. Drop in interest rate is a very good scenario for business expansions. So considering three factors now: sentimental factor, easing geopolitics issues; technical factors, golden crossovers on Nifty daily chart, and super trend bullish on Nifty weekly chart. Third one, fundamental factors: stable GDP growth rate, fall in interest rates, and fall in inflation rate. These are strong indicators that Indian markets will outperform for the next few months, unless sentiment factors like geopolitical issues disturb them. Like major geopolitical issues like wars or trade wars, these can impact India, the stock markets. Considering these factors and indicators, we take a bullish stand on Indian markets. Now let us examine which sectors support indices like Nifty and Sensex. We observed and researched the performance of the entire Indian sectorial index over the past 2 months. The following are the sectors supporting. One is Bank Nifty, Financial Services, the second one, Oil and Gas, the third one, Consumption, the fourth one, and Auto sector, the last one but not least. Other sectors such as metals, energy, infrastructure, IT and commodities perform well, but however they are not up to the mark, and the chart patterns are also not that impressive currently. So currently, according to our analysis, we observed a strong chart pattern in these 5 sectors: banks, financial services, oil and gas, consumption, auto. Fundamental factors that supporting these sectors, as we said, every technical fact should be supported by a fundamental reasons, or else the technical facts are useless. So now let's consider the fundamental factors of these 5 sectors. During interest rate cuts and favorable monsoon conditions, the auto sector, finance, and banks will definitely perform well. I mean, that is what previously happened. When crude oil is trading at all-time low and continuing the downtrend, even American administration is always telling drop the crude oil prices and drop the interest rates. So this is a very good scenario for sectors like aviation, airlines, like Indigo stock. You see the stock has been bullish and gave almost 30% returns in very short span of time. Oil and gas companies also will perform when the crude oil is falling. So that is why oil and gas sector is also supporting the Nifty, and energy sector is also supporting, because crude oil, basically the primary energy is crude oil, is almost all-time low, and it is dropping and it's continuing the downtrend. The third thing we have to notice is income tax reduction. The Ministry of Affairs, no tax up to 12 lakhs per annum, and other income tax benefits, which actually a major move by Indian government. This helps the Indian taxpayers to save their disposable income, which will help the consumption sector to perform. Finally, considering these factors discussed, we stay bullish on Indian markets, 5 sectors and few stocks. But this is entirely our research and analysis, not a recommendation or a tip or a calls to buy. You can do your own analysis using our information, and you can give us your feedback, like if you are going wrong in any part of our analysis, so that we can discuss and improve the things much better. Now coming to the banking sector, we picked a few stocks like Union Bank and Canara Bank, ICICI Bank and HDFC Bank. If you are expecting modest returns, but if you are expecting some aggressive returns, then Union Bank, Canara Bank and IDFC First Bank, these 3 banks can, we are expecting some more like aggressive returns. IDFC First Bank is still a risky stock, but if you are conservative approach, then Union Bank could be a good example. Why Union Bank? First we'll see the technical factors. You can see the chart patterns. The left is a weekly chart and the right is a daily chart. On the weekly chart, super trend indicates bullish activity with above average volumes. You can see the volumes as well, are above average, and you can identify the crucial cup and handle pattern with rising volumes on the right hand side of the daily chart. You can see EMA crossovers with filters supporting bullish trend. So the immediate question is, since the stock has already rallied up from its low, can we invest now at this price in the Union Bank? This should be addressed considering again 2 factors. The number one is technical factor. Let's see the technical factor. On the weekly and daily chart, again you observe on the Union Bank, the RSI crossed above 60, indicating that stock is bullish but not overbought. The overbought condition is when RSI is above 70 or 80. But these technicians should be again supported by fundamental factors, or else no technical analysis is worth without any fundamental ground reason. So the fundamental factor, let us examine a few key metrics of Union Bank. First metric, let's see the valuation, whether we can invest at this value. For banks, the primary valuation metrics is price to book value. You can check in check in screener.in and compare Union Bank valuation, relative valuation with other banks. So if you see the current valuation, that is price to book value, is below 1, and which is much lesser than other banks. So the book value of Union Bank is completely less than the book value of Union Bank is comparatively less than other banks. The PE ratio is lower than industry average, and the PEG is much less than 1. Fine, the company is relatively undervalued, so you can buy. But the question is like, are the revenues good? What about the business? The next question is about the business. Like if you observe the EPS growth rate, the crucial, like earning per share, like if I'm investing 100 rupees in any company, how much I'm going to make is the primary metric which I have to look for. And that I can get it from looking at EPS growth rate. Earning per share growth rate has been about 20% from past 3 quarters. So there is a growth revival from the 3 quarters. The company is performing very well. The EPS growth rate is about 20%, which indicates strong quarterly results, and the company has a history of giving even better result. You can see the chart here. There are times like quarterly results are above 50% as well. Now the current quarter also given 50% compared to the previous quarter of the last year. So this is showing that quarterly results and the revenues are good. The key concern is not the EPS. EPS is good, but the revenue growth rate is not as per our expectation. It didn't meet the 10% criteria. We expect it to grow with the economic revival, because currently the economy is reviving. We observe the same scenario in Canara Bank, but we choose Union Bank because the debt to equity ratio is very high for Canara Bank. So yeah, if you consider, we are expecting, because monsoon is in favorable condition, interest rates are dropping, so we are expecting the revenue growth rate of Union Bank will be good in the upcoming months. Okay, similarly we found similar patterns in stocks like TVS Motors, MCX and Divi's Lab, but these are high value stocks trading at very high valuations. So please check their historical PE, PEG ratio and other metrics, and you suggest us in the comments whether we can consider buying these stocks or not. So yeah, this is all about our golden crossovers. I hope you enjoyed our video. If you liked our content, please like, share, subscribe and comment with your feedback. Thank you. Thanks for watching.